Risk management is a crucial aspect of trading that involves identifying, assessing, and prioritizing risks, and implementing strategies to minimize their impact. Effective risk management helps traders protect their capital, improve consistency, and achieve long-term success in the Forex market. Let's talk about the key points in risk management. First, capital preservation. This is about protecting your trading capital from significant losses. Next, risk assessment. It involves evaluating potential risks before entering trades. Then, position sizing. This is determining the appropriate size for each trade to control risk. And finally, who should use risk management? Well, let's dive into that next. Risk management is essential for all traders, regardless of their trading style or experience level. For day traders, it's crucial to use tight stop-loss orders to manage risk on short-term trades and focus on maintaining a high win rate to offset smaller average gains. Swing traders, on the other hand, should use wider stop-loss orders to allow for market fluctuations and focus on achieving a balance between risk and reward. Lastly, position traders use fundamental analysis to assess long-term risks and focus on maintaining a diversified portfolio to spread risk. For beginners, risk management offers several pros. It helps prevent significant losses and protects trading capital. It encourages disciplined trading and consistency. Moreover, it builds a foundation for long-term success in trading. Let's dive into some key risk management techniques. First up, setting stop-loss orders. A stop-loss order is an order placed to sell a security when it reaches a certain price, thus limiting the trader's loss on a position. It protects against significant losses by automatically closing a losing position. The pros? It provides a safety net for trades and helps remove emotional decision-making. However, it may result in premature exits due to market fluctuations and requires careful placement to avoid being triggered by normal market noise. For example, if you enter a long position on EUR/USD at 1.1000 with a stop-loss order at 1.0950, you're limiting your potential loss to 50 pips. Next, setting take-profit orders. A take-profit order is an order to close a position once it reaches a certain level of profit. This secures profits by automatically closing a winning position. The advantages include locking in profits without needing to monitor the market constantly and helping maintain a disciplined approach to trading. The downside is that it may limit potential gains if the market continues to move in your favor and requires careful placement to maximize profits. Imagine entering a long position on EUR/USD at 1.1000 with a take-profit order at 1.1100, securing a potential profit of 100 pips. Moving on to position sizing. This involves determining the size of a position based on the trader's risk tolerance and account size, controlling the amount of capital risked on each trade. It helps manage risk exposure and allows for consistent risk management across trades. The challenge here is that it requires careful calculation and discipline, and may limit potential profits on winning trades. For instance, with a $10,000 account, you might decide to risk 1%, $100, on each trade. If your stop loss is 50 pips, you can trade 0.2 standard lots, 20,000 units, of EUR/USD. Another technique is the risk-reward ratio, the ratio of the potential profit to the potential loss on a trade. It helps evaluate the attractiveness of a trade, encouraging high-reward, low-risk trades and helping maintain a disciplined approach to trading. However, it requires careful planning and analysis and may lead to missed opportunities if set too conservatively. For example, entering a trade with a stop loss of 50 pips and a take profit of 150 pips results in a risk-reward ratio of 1 to 3. Lastly, diversification. This technique involves spreading investments across different assets or markets to reduce risk. It mitigates the impact of losses in any single position, reduces overall portfolio risk, and increases the potential for stable returns. The con is that it may limit potential gains if one position performs exceptionally well and requires careful selection of diversified assets. For example, instead of putting all your capital into EUR/USD, you diversify by also trading GBP, USD, USD, JPY, and AUD USD. And finally, using leverage wisely. Leverage allows traders to control a large position with a small amount of capital, which can amplify both gains and losses. The pros include increasing potential returns with a smaller initial investment. However, it also increases the potential for significant losses and requires careful management to avoid margin calls. Now, let's explore some essential risk management tools. First, the PIP calculator. This tool helps traders calculate the value per pip in their account currency, simplifying risk calculation and aiding in setting appropriate stop-loss and take-profit levels. However, it requires accurate input of trade details. Reliable sources for a PIP calculator include MyFXBook and Baby Pips. Next, the position size calculator. This tool helps traders determine the appropriate position size based on their risk tolerance, ensuring consistent risk management and helping avoid over-leveraging. Like the PIP calculator, it requires accurate input of risk parameters. Reliable sources include MyFXBook and Baby Pips. Then, the risk-reward calculator. This tool helps traders evaluate the risk-reward ratio of a trade, encouraging disciplined trading decisions and helping identify favorable trade setups. It requires careful planning and analysis. Reliable sources include Baby Pips and Forex21. Lastly, the economic calendar. This calendar lists upcoming economic events and releases, providing timely information on economic releases and helping traders avoid trading during high volatility events. However, it requires continuous monitoring. Reliable sources include Forex Factory and Investing.com. For example, using an economic calendar might help you avoid trading EUR/USD during the release of the U.S. non-farm payrolls report. Combining multiple risk management techniques and tools can create a more robust trading strategy. Risk management is a fundamental aspect of successful trading. By implementing techniques such as setting stop-loss and take-profit orders, determining proper position sizes, maintaining favorable risk-reward ratios, diversifying trades, and using leverage wisely, traders can protect their capital and enhance their long-term profitability. Utilizing tools like PIP calculators, position size calculators, risk-reward calculators, and economic calendars can further refine and improve risk management practices. It is essential for traders, especially beginners, to develop and stick to a risk management plan to achieve consistent and sustainable trading success.